Are tech giants borrowing to supercharge AI and cloud? And what does that mean for your portfolio? Here's why a quiet bond boom is shaping the next leg of technology growth. Big technology companies are tapping the bond market to fund data centers, specialized chips, and global cloud expansion. They are doing it now because credit markets are open, investor demand for high-grade debt is strong, and windows of stability allow them to lock in funding. The result is faster AI rollout without draining cash reserves that support operations, buybacks, and dividends. The core driver is simple. AI is capital-intensive. Training large models and running them at scale takes massive compute, storage, and power. Multi-year financing aligns better with assets that last a decade than paying entirely out of current cash. Even with policy rates higher than before 2022, credit spreads for top-tier tech names remain tight, so all-in coupons look attractive to issuers and acceptable to investors. Balance sheet strategy matters. Cash-rich platforms prefer to preserve liquidity for flexibility while matching long-lived projects with debt. They also time offerings when volatility eases and risk appetite improves, which helps pricing and execution. That is why you see clustered issuance when markets calm. Proceeds are flowing to very specific buildouts. New and retrofitted data centers with higher rack density, liquid cooling, and stronger power redundancy. Long-term commitments for advanced GPUs, accelerators, networking, and storage. More cloud regions, edge locations, and security layers to meet enterprise demand. And energy strategies that secure power, add renewables, and improve efficiency to manage costs and emissions. Issuers range from mega-cap platforms to established enterprise software and hardware providers. Deals often ladder maturities, mixing shorter tranches for flexibility with 10 to 30-year bonds that match the life of infrastructure. Some transactions use green or sustainability-linked formats when proceeds align with eligible projects. What should investors watch? Pricing versus treasuries and sector curves to gauge value. The tenor mix, since longer bonds add duration risk if yields move. Clear disclosures on CapEx, AI roadmaps, and return hurdles. Discipline around leverage and buybacks so growth does not erode credit quality. The takeaway, AI's build-out is shifting from storyline to financed execution. For equity holders, bond issuance can accelerate growth without exhausting cash. For bond buyers, high-grade tech offers yield with tangible asset backing. But duration and transparency still matter. Read the full article at finlitica.com.